Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest is Scott Hazlett, and Scott is a California attorney and CPA who practices in the areas of taxation, real estate, estate planning, financial problem resolution, and 1031 exchanges. He's a certified specialist in taxation law, California State Bar Board of Legal Specialization, and he's also a qualified intermediary for tax-deferred exchanges. Scott previously worked with Pricewaterhouse and was an investment executive with Merrill Lynch. He graduated from Taft University School of Law in 1996 and set up his own law firm. He's a past president of the East Bay chapter of the California Society of CPAs, and in a past life he was a sports writer covering Major League Baseball, National Football League, and other sports. So today, Scott and I are going to talk about real estate professionals and passive activity losses, mostly as it relates to real estate, of course. And related to that, we suggest that viewers who are real estate investors should get copies of Publication 525, which is residential rental property, and Publication 925, which is on passive activity and at-risk rules, at the IRS website, which is www.irs.gov. And before we get started, I also want to caution our viewers that this is a very complex subject, and if you're dealing with these issues, you should get help from a competent tax advisor. That really, I guess, is the bottom line of really all of our interviews. So, Scott, thanks for joining me today.
Hey, thanks for having me. I really appreciate it.
Okay. So, what sort of things have happened in the last couple of years that why more people might be more concerned about the passive activity loss rules?
Well, I think it's to take a step back even further to discuss what that's all about,
all right.
The passive activities. So it seems like just yesterday, but Tax Reform Act of '86 instituted these rules called the passive activity
That's
rules.
when our hero Ronald Reagan was president, right?
That's correct. That's correct. What was that? I heard a quote the other day. Republicans think of 4th of July and Democrats think of April 15th. So that we commonly call them PALs, P-A-Ls, passive activity losses. And
yes.
So the initial moniker was "Pals are not your pal." You know,
okay.
So in the good old days before the '86 Act, we could buy a piece of rental property, for example, or an office building or something, and have then accelerated depreciation, as you recall, and we could have a tax loss, a significant tax loss in an activity.
I think it was 15 years depreciation.
Yes, 15 years from '81 to I think '83 or so.
Yeah.
And then, and so what happened was that people would go out and buy this property, and they would be doctors, dentists, CPAs, lawyers, and you were able to just write those losses off directly against those wages or interest and dividends and those types of things. So Congress said it wasn't really fair. What does Congress know? But anyway, that's what they said, and they can say it. So the government passed these rules that said that, generally speaking, if you have losses from rental properties like that, they won't be allowable immediately against your wages and dividends and so forth. They're a separate category called passive income from passive activities. And by definition, rental properties are considered passive activities. Even though you might be the only guy on the case doing all the work, it's still considered de facto a passive activity. So then if you fast forward to 1993, the real estate community, the brokers, the developers, construction industry, et cetera, they were complaining every industry in America can incur a loss and take it as a deduction on their tax return, except for us. So this isn't fair. Mm-hmm. And so they said, yeah, you're right. Congress said, yeah, you're right. So what we're going to do is we're going to carve out a special exception for real estate professionals, as the moniker was raised in the tax code. And if you're a real estate professional, and if the activities, the rental activities, rise to a certain level, which we call a material participation activity, which is very complicated, then if you meet those two tests, then you're not subject to the general rule of not being able to write these off. In other words, you can write them off. You could have some rental real estate, make big losses, and write them off against, say, your commissions from your brokerage activity and so forth. So that was really a positive thing. So I don't know if that answered your question, but that's the background.
Okay, so that was those two developments, and then along comes the net investment income tax.
Oh, that's true. So beginning 1/1/13, it's probably not fair, but I call it the Obama tax, but
Okay.
that's just my persuasion.
Okay.
To supplement the Medicare fund, the Congress passed a rule called the net investment income tax. It's found at Section 1411 of the tax code, and it's an excise tax that's in addition to all other payroll taxes and all other income taxes, state and gift taxes. It's another tax, and there's this concept of net investment income, and net investment income, generally speaking, is interest, dividends, royalties, and can be net income from rental activities in most situations, except for a few. And so, and there's some thresholds and so forth, and you can read the statute yourself. But if your adjusted gross income is for a married couple above $250,000, and then you get this net investment income, then you're subject, at least partially, to the 3.8% on that income, in addition to all other income taxes and so forth. So how does that interplay with passive activities? Well, the rule is written in such a way that if you think about like a brokerage or an accountant's income or a doctor's income, self-employed person, there's a Medicare tax that's associated with that. If you're a wage earner, you pay a Medicare withholding through your payroll. If you are an investor, before this law came in, you didn't pay a tax. And so the perception was, there's a bunch of rich people out there not paying their fair share. So let's put this rule in that they should pay an equivalent tax on unearned income. This is net investment income tax. They applied it to rental real estate, but then they said, well, wait a minute. Rental real estate is sort of a special thing, because sometimes it can be a business. Sometimes it can be a trade or business. And if you can prove that it's a trade or business, but it's still a rental, so you're kind of in a best of both worlds. You're not really a business for the sake of paying the payroll taxes, but you're not really an unearned income for the sake of paying this thing. So you're on what I call the beautiful razor's edge, which is you don't have to pay this tax.
Right.
So the passive activity rules and the real estate professional rules tie in to determine whether or not you are subject or whether you're on that special razor's edge.
Right. Yeah. So it's sort of a brave new world, and folks, the accountants and the attorneys are almost as confounded by all of this as you are.
That's correct.
So be aware of that. So maybe then we should sort of recap then. Why would someone want to qualify as a real estate professional?
Okay, so I mentioned a minute ago that you have a rental property and you lose, say, 10 grand on the rental property. And in the good old days before the 86 Act, you could just write it off against your wages, and it was a sort of a benefit because you'd get a tax reduction immediately. So then the rules came in. Now you have these losses, and the rules provide the losses aren't lost. They're not just thrown away, but they're accumulated and deferred. Mm-hmm. And typically the idea of the law is it matches the date when you sell. So you sell the property, and all those losses from the prior years trigger at that point. Mm-hmm. And it serves to be a matching concept, matching the gain or revenue with the loss. So, but on the other hand, if you're a real estate professional, because the passive loss rules don't apply to you, you actually do get a current loss against your commissions, your other income, dividends, mm-hmm. interest, and so forth. So there's a great deal of motivation in many cases to be a real estate professional and qualify under these real estate professional rules to avoid the passive activity loss rules.
Right. So, like we said in the past, that was the main focus, and now we've sort of got a flip that's happened because of this net investment income tax. And so now, if you're generating gains or income from your properties, you can also get a tax benefit by avoiding that tax.
That's correct.
Okay. Now, do both a husband and a wife have to qualify as real estate professionals to get the tax benefit?
So let's focus on the two components, and we'll answer the question about the husband and wife. So the two components are: is the taxpayer a real estate professional?
Yeah.
And a real estate professional is certain trades or businesses in real estate development, construction, brokerage, leasing, and so forth. There's a list in those publications that you mentioned. And the test is, has the person spent at least 750 hours in a tax year as in this job, and does that constitute more than half of all the time they spend? So for example, if I'm a real estate agent for 750 hours, and then I spend 500 hours selling newspapers on the street corner, well, I would qualify because I've met the 750 minimum threshold, and over half of my time is spent doing the real estate activity. So that's test number one. Test number two is, does the activity itself constitute a material participation activity? I think we can defer that a minute, but it's a taxpayer test first, and once you pass that, then you go into this activity by activity analysis. Now the question you had was husband and wife. So there's a real busy orthopedic surgeon spending 2,400 hours a year doing her practice, and she likes real estate and she dabbles in real estate, and she's got a kind of a lazy husband, and he says, well, our accountant said that if we were a real estate professional, then we could maybe get losses against your fabulous income, which I just love you for, dear. And she says, well, that's great. Why don't you go join ABC Real Estate Brokerage as a real estate broker or agent, which there's another distinction there. Get your real estate license, go do that activity, and the husband spends 750 hours, and that's the only thing he does because he's lazy, so he spends 750 hours doing the real estate business. So they jointly qualify because they're married to each other. Only one spouse has to be that real estate professional.
Right. Okay. Okay. Maybe since we have gone a little bit through, so why don't you talk a little bit more about this material participation, and maybe talk a little bit about, do we have to look at it property by property,
Correct.
or are there
Correct.
special elections available?
So the general rule is that each property is considered an activity. So let's say I have 5 duplexes, and that's what we would call in tax world Schedule E. I'm an individual, I own 5 duplexes. So I got property A, B, C, D, E. Each of those activities is measured on its own merits as to whether I am materially participating in that activity. And the code section 469 is where all these rules are found. The 469 regulations talk about 7 different ways that a property could qualify as a material participation activity. Sort of the default rule is if you spend 500 hours on that property, on that activity, doing certain things, then that is a material participation. That's a general rule under 469. I think the regulations recognize the fact that it's pretty hard to spend 500 hours on a duplex, just not in a year.
Mm-hmm.
So a couple of things. First off, it says if you are the only person that does all the stuff, irrespective of how many hours, then we don't care if it's 90 hours or 50 hours, but you're the only person, there's no managers and nobody else, you're the only person that does it, then that will be material participation with respect to that activity. Another test might be if you do more than any other person, there's some other people help you, from time to time, but you do more than any person that you hire, and you spend more than 100 hours on that activity in a year, well, then that's going to be qualifying as a material participation activity. So remember our test. First, I'm a real estate professional because I'm a broker or a leasing agent or something. And second, this activity now is a material participation. So losses from that activity go right to page 1 of my Form 1040. They're not suspended, they're not passive. Okay? So it could be that B and D qualify and A, C, and E don't qualify. That's a possible outcome. Recognizing that there's a lot of synergies and economies of scale, I think, and so forth, the code allows for a taxpayer to make an election to aggregate the activities, to group the activities. So in effect, you say, I'm electing to aggregate all my activities, and so now, if you spend 21 hours on each of the 5 properties, that adds up to over 100 hours, and you're providing more services than anybody else, all of those 5 are considered not passive because they're one activity, not 5, and you are materially participating according to the regulations. So it's a way to basically build up hours with respect to these activities.
Right. So, and it's a commonly missed election,
Correct.
I think.
Correct.
And so people, it would make it, they would have qualified if they made the election, but then they missed, and then then they're out.
That's correct. That's correct.
Okay. Let's see here. Do the same rules apply for federal and state reporting, like for California?
So the federal adopted this in 1993, as I mentioned, and some of the minutia has evolved, but the general concept remains after all these years. California never adopted this rule. So let's say, for example, you have aggregate 50,000 in losses from your real estate that, for federal purposes, you're allowed to deduct. You're going to see an add back of 50,000 on your California return, and those losses will be suspended at the California level.
Right. So when you are a real estate professional and you have these rental activities, do you report them any differently from other taxpayers?
Yes. First off, the obvious one is that you actually put the loss on page 1. So compare two taxpayers. One is a dentist who doesn't do real estate. He just owns the investment real estate, and he has aggregate of losses of 50,000. So what's going to happen on his tax form is, on page 1 of his tax return, it's going to be a goose egg on the rental line. And for the real estate broker who does meet all these tests, the 50,000 is going to be a negative number, a loss, a deduction for adjusted gross income. That's the first thing. The second thing is that when you report your rental activities that are considered real estate professional, the last line on page 2 of the Schedule E has a thing that says reconciliation for real estate professionals. If there's a number in there, you've just told the IRS, you've raised your hand, you flagged your return, and you said, I am this, and parentheses, come and see me if you want. That's kind of what because you've claimed this. By the way, this is not an election. This is mandatory. So you can't say, I don't want to take it, I want to just defer. If you qualify for this, you can't elect out of this. This is a mandatory treatment. So those are the two most obvious ways that this is manifested on the income tax return.
But one thing is that as far as the basic form, the Schedule E is still where the
correct. It's just when you get to the bottom line is how much are you allowed to deduct?
Yeah.
Sometimes zero, sometimes something.
Okay. Okay. So let's say you have somebody. Let's say you have a dentist and he's single and he comes to you and he says, "I want to be a real estate professional." What would you say to him?
Well, we had a case like that. It was actually a different person in a different profession. And we talked about the time, and the main test is half your time spent doing the real estate, half your time. So the dentist is, I'm going to guess, is working at least 1,500 to 2,000 hours a year, probably. So that means that person has to work as many hours plus one in the real estate trade. And it's just probably not going to happen. So my practical answer is, are you willing to give up your dental income to get this loss? Keeping in mind that you're not really losing the loss, you're just deferring it.
Yeah. So I mean, I've had these people come to me, and basically I've said, if you've got W-2 or something else, where you're indicating full-time employment, it's remote that you will be able to qualify.
That's correct.
And basically what we've been seeing is case after case after case coming before the tax court. And basically, and some of them, the people are saying, yeah, here's all the hours, here's all the records. And the judge is basically saying, I don't believe you.
Right. It's pretty difficult to believe that, yes. So you might advise them to get married?
Yeah, whatever.
One thing, before we go on, one thing I want to mention about this election. I don't want to leave people with the impression the election you just do it automatically. You take pause. Well, first thing is the election is generally irrevocable, although you can revoke if the circumstances change. And also keep in mind that if you don't have the election in place and you sell one of these properties, it's conceivable that you sold a property at a loss and you could take the loss against your income. But if you've grouped all these activities into 5 activities, and you sell one, the loss from that is considered part of this one activity that's not fully sold yet, and you can't deduct it against your page 1. So you really have to more than just say, oh, just check a box, because the computer lets you check a box. TurboTax or the software you and I use, it's easy to check a box, but the impact of it really needs to be evaluated because it's not only that year, but it's all future years.
Yeah, I think it's more significant for if you have passive losses from previous years. So then your losses that have been suspended from previous years, you won't be able to deduct when you sell the property because it's not a total disposition. Okay, so do you think real estate professionals are an audit target for the IRS?
Absolutely. I mean, I got 2 or 3 going all the time.
2 or 3 audits?
Yep.
Okay.
Yep. That's the focus. In fact, the last one I was
so far I've been lucky, but I think I've got the right case, situations.
I was doing one. I was in the IRS office last week, and here's the interesting thing. So normally, in an audit, they say prove your things by your checks and your paid bills and all this stuff. The auditor said to me, I will accept all of your deductions. I'm not even going to look at that part of it. So this guy has claimed insurance and mortgage interest and all this stuff. I'm only interested in determining whether or not this person is allowed to deduct it currently. So that speaks volumes, I think, to what's going on.
All right. And there have been situations, you and I both know, of people trying to construct these records after the fact.
Right.
They've got an audit that's going on, and suddenly they're trying to put together a calendar and so forth.
Right.
The IRS wants current records. You're supposed to be keeping really a diary of what you're doing.
The regulations are surprisingly a little bit lax in that, but the advice is do keep a diary. Now this is one I just mentioned. The wife in this case was the real estate agent. She worked for a national agency, and she had a calendar. She had all the appointments. So remember, you got not only the real estate activity that you're trying to get done, but you also have to prove that your work. And she had appointments every weekend, and she had open houses, and so it was clear that she really worked at it, and that was her evidence, and that's the best. That really is the best.
So in my situation, I have some people that basically their business is it. That's it.
Yeah,
that's all they do. They don't have another occupation.
Correct.
And so so I feel pretty confident in claiming real estate professional status for them. But
let me mention one other thing too. Is there's a special rule about these real estate professionals about ownership of the entity. The most common real estate professional is probably a broker or a real estate agent. The person who works for a real estate company in that capacity but doesn't own at least 5% of that company is not considered a real estate professional. So that's very important. I've had people come in and they say, hey, I work for ABC, huge real estate company, and we do property management. I do property management. I'm an asset manager. I do all these things. And yes, you qualify. The hours qualify and everything, but there's a rule that says you got to be at least a 5% owner, and this is a public company, and you're not at that. And so they do not qualify. So be very careful about that.
Well, another one that's been coming up recently is mortgage brokers.
Correct.
Maybe you can talk about that for a second.
Well, in California, there's 2 issues. I think that's the Fitch case. The one case was the 2 offshoots. One is the regs and the code talk about a broker. So the scheme, the regulatory scheme in California is a broker is an independent person who can do real estate activities. A salesperson, oftentimes called an agent, is subservient to a broker and cannot do real estate on her own account. It has to go through a broker. There was a case, I believe it's Fitch, where the taxpayer said, hey, I'm a real estate agent, I'm a real estate professional. And the IRS said, no, you're not a broker, you work for the broker, so we're going to discount that. The court found that person to be a real estate professional because of the way the licensing scheme is in California. The second piece of it is the mortgage broker. So the mortgage broker in the California scheme is licensed to do loans if they have a real estate license. So I do have a real estate broker license, and for many years I actually originated loans as a real estate broker. So the question is, was I a real estate professional? Now, in my view, I think I was. IRS is saying, no, that's not really real estate. That's mortgage, that's money. That's not really real estate. That's a different story. So that remains to be seen as to really the outcome.
Yeah. So far, I think it's like chief counsel advisors and other things have been saying something to the effect that they're not.
Correct.
So I guess we can say this is not a slam dunk.
No, Absolutely not. And the best time to learn the bad news is before the bad news takes you down the path of an audit. I mean, it's just these audits, and they get into your books and your calendars, and it's just very difficult. Just very, very difficult.
Yeah, and this has to do to some degree with the self-prepared returns, but for many people, and especially when you're claiming this status, I'd say it's an accident waiting to happen.
Yeah, the sort of I chuckle. First off, disclaimer: TurboTax does a fine job. The computers. It's a great, for those that sort of know how to do it. Simple situations, fine product. So the computer does it right. They don't let you take the deduction, and you keep slamming your finger on the keys on the computer, saying, "Darn it, I want to take that deduction."
Override.
So they override the deduction, and then they file the return. And the computer warned you 17 times, and you said, "I don't care, I'm doing it. I'm going at it. No helmet. I'm going for it." And then you get slammed with an audit, and you lose because you didn't pay attention. So.
Okay. Well, folks, you've been warned to some degree. This is not for the faint of heart. On the other hand, when your situation is legitimate, you can claim this status, and it's okay. It can be audited, and you can get through, but the facts have to be right. You have to be conscientious. You have to keep the records. Okay? Get good tax advice. Work with a good tax return preparer. I think when you're doing this sort of stuff, it's going to be worth it in the long run. You'll be glad you did. I have a book, Real Estate Tax Handbook. It's available on Amazon.com. I have information on there about passive activities and real estate professionals. Scott, thanks for joining me today.
Thank you very much.
And we'll see you next time on Financial Insider Weekly.